this is at the core of, I think, my diagnostic about what is the problem with much of economic models, which is, for example, to throw away most of the models that exhibit the finite time singularities. And this will be the core of my discussion. So I'm interested in financial bubbles. Why? Because during my life, I have found that it's very interesting to look at monsters, big deviations, extreme, and so on, in order to understand systems. For example, we, since 2008, had this massive crisis with, direct subprime loss of a few $100 billion, which cascaded into, let's say, $5 trillion in world GDP just in 1 year, and almost $30 trillion in stock market losses. And it's clear that when you look at what was happening before, there was the discussion of a great moderation, but also accompanying the great moderation is what I call a global bubble. So this is just one summary of many other indicators where you could see the valuation of essentially everything skyrocketing in an accelerated way. And I'm going to build on this to show you a series of mathematical models that we have played with in order to characterize these extraordinary trajectories, which are transient, which can be modeled by this class of finite time singularity models. And a key question that I think the literature and most of the persons do not answer yet is, why did it happen? And here I show a famous plot of the Case-Shiller home price index, which shows these growths, more than doubling in price just in a few years. And the big question is, why did it stop growing? And indeed, many analyses show that, it's because it stopped growing that the subprime borrowers start to default and so on, while as long as the market was going up, you could play the musical chair and continue forever. And so you can ask the question, why did it stop growing? Why did it not continue forever, given the fact that in the last 50 years, the real estate stock market has been showing essentially this monotonic behavior, giving the impression to the public, to the professional, that it was without any risk, that the stock market, the real estate market will continue growing forever. And so this is one of the questions I want to address, and I hope to give you a proposition for an answer at the end. So I'm interested in bubbles because I think that there are preparations of this extreme crisis, and in particular now, in addition, with the easy money, the quantitative easing, the specific low interest rate policies and so on, are seen as a response to previous bubble times. And there will be not only the past, but the future, many other bubbles. And I will show you, if I have time, briefly or privately, that with our financial crisis observatory at ETH Zurich, we are monitoring these bubbles in 25,000 assets worldwide, and we see these dynamics going on more and more rather than less and less. So this asks the question, but what is a bubble? So this is a difficult question. Actually, the economic profession is divided on this, and of course I summarize the problem in a very simple way for lack of time. For example, you have this review, which was published a few years ago, analyzing the different economic testing for the presence of asset bubbles in different empirical data. And the problem was that there were as many claims of, let's say, the rejection of the model taken as a basis suggesting the existence of a bubble, as there were opposite claims that the same time series, the same so-called bubble could be explained without the existence of a bubble. And the problem, of course, we know comes from various issues, in particular the sensitivity of the valuation of the parameters. The simplest example, of course, is the Gordon-Shapiro equation, right, which say that the price is simply the dividend divided by the risk premium or the discount rate minus the growth rate of the dividend. And because you have this denominator and two numbers which are one minus the other, a small variation of any of them can make a change of a factor of 2 in the price. And so it's clear that depending on your preference, you can explain or not explain the existence of a bubble. Another difficulty, I think, is that everything in economics, everything in finance grows exponentially. This is the law of compounding interest. So now the equation of identifying a bubble is about identifying a so-called anomalous exponential growth. In the literature, you read about explosive exponential bubbles. But everything is exponentially growing in economics. So again, it's about deciding if a growth rate is unsustainable. And this is, again, very difficult because then it's about the question of what is the behavior of the underlying basis of the economy. So it's very difficult. In the professional literature, even more so, for example, there's this famous quote of Greenspan, 2002, and I think it still reflects by and far the position, for example, of the central bank, that you need a burst, you need a crash in order to be sure there was a bubble. So we would like to do a bit better in modeling. So what is a bubble? Let me first tell you what is not a bubble in my view, and debunk some ideas very, very clearly. For example, is it an exponentially exploding price? Probably not enough, because everything is growing exponentially. Is it an exploding volatility, as, for example, Jarrow is proposing? And I don't have time to show you, but we have a working paper now where we have analyzed 50 bubbles worldwide, massive excesses that were followed by crash. And we document that in most of them, the volatility did not explode. And the clearest example maybe is this one, where you see the implied volatility during the bubble growth of the, for example, S&P 500, and then you see the explosion of this implied volatility at the day of the crash on 19 October, Black Monday, 19 October 1987, and then this memory, this response function for several months. So yes, indeed, there is a burst, there is an explosion of volatility, but it's not a precursor. It is on the day of the crash when everybody is running to the exit, so to speak. So I don't think that actually the type of model that put this volatility, the mathematics is very sophisticated, very nice, but I think it's missing the empirical evidence that support this. So what is about? My proposition is that we need to take into account positive feedbacks. So this is summarized by the contrast of the standard, where am I here? Yeah, the standard, Econ 101, equilibrium idea of supply demand. When the price increases, the demand decreases, to a regime where the larger the price, the larger the demand, or the larger the previous returns, the larger the demand, which seems very surprising or non-rational a priori, but does happen and has happened a lot, as I'm going to show you and document and argue. And this is, of course, the exact opposite of the mean reversal, which is at the core of many mathematical models that we are used to use, which correspond to negative feedback. An excess of valuation tends to be arbitrage away because rational, let's say, investors recognize this higher valuation and then would sell and push the price back to the kind of equilibrium. Positive feedback is exactly the opposite. The larger the deviation from some fuzzy, ill-defined final value, actually the larger the forces, the larger the demand that may push this price away from this reference value. And there are many mechanisms for positive feedback, which I think are not enough recognized in the literature, even if they are obvious. And these are my list of probably far from exhaustive. I would be happy if you come up with others. One, for example, just option hedging that we use for Black-Scholes theory. The fact, if you take into account the market impact of your position, your hedging, necessarily you have a positive feedback. And Papanicolaou, for example, already in 1998, has a paper showing that it increased very significantly the volatility. But even more naively, the fact that I am a bank, I sell you a call option. If the underlying price goes up, I have to buy more of the underlying, therefore pushing upward even more the price. So very direct positive feedback. And these are many of the, several of the direct positive feedback that tends to actually accelerate in a pro-cyclical way the deviation from equilibrium. And there are also, of course, in addition to technical and rational mechanism, behavioral mechanism, very important, imitation and so on. The positive feedback were in full power in the decade before the crisis in 2007, 2008. And this is my attempt to compile the many discussions in the literature trying to pinpoint what was the cause of the crisis. And you have papers that many papers that identify each of these bullet points in detail, emphasizing that this was going on. And I don't have time to go through each of them, but they all participated into this access, this positive feedback, rather than negative feedback tending to, let's say, stabilize the system. Speaking of behavioral phenomena, which I think dominate and actually combine with technical positive feedback, of course, imitation, we have to cite it, is very rational. It is the highest cognitive level, which is only shared by us, apes, and some birds at a high degree. We have this concept of information cascade, this report in a recent journal of finance that hedge fund managers tend to overweight their portfolio in the same manner when they live in the same city. So you have in our global village this remarkable effect of interaction effect, because they go to the same conference, the same cocktail, the same meeting, and so on. And biological science informs us that probably as a result of evolution, our brain has developed modules of decision that makes us over-imitate as a very successful, let's say, strategy in order to survive at the time of hunter-gatherers, and which, of course, lead to maybe excesses in the modern world. But as I said, it's very rational to imitate when you have limited time, limited resources, limited information. Maybe the neighbor has some useful information. And there are very nice experiments that show that positive feedback gives rise to synchronization, to global behavior, to aggregate behavior, like this clapping of hands in a theater, where the positive feedback is from the reception of the auditory signal that goes to the brain, goes back to the neuromotoric system that then control the clapping, and then suddenly, spontaneously, everybody is clapping simultaneously. An example of positive feedback giving rise to the emergence of collective behavior, which is basically the essence of the model of the models that I'm going to develop in order to understand what are bubbles and crashes. So just to summarize very quickly, of course, an enormous body of literature by many researchers, we have something which is more than a story. This is a collection of many, many repetitive facts that show that we have something to explain in our models, in mathematical models. So this is a kind of prototype structure of how a bubble develops, with first, displacement of a new innovation or a rebirth after a kind of recession. Then the stock market goes up, the access to credit is easier, marginal requirement decrease, credit creation grows, fuels back to the economy, the stock market grows, etc. The merger and acquisition booms. There's a stage of euphoria, the price of the stock market go up and so on, until it is not sustainable and there's a crash, a revulsion. And you can see in terms of the type of money, you have start money at the beginning, institutional investors, the public, and then my grandmother takes the money out of the mattress to try to run after these extraordinary gains. So in order to capture this positive feedback, I'm going to use a type of processes which are not, so of course, stochastic, but here I'm just showing a very simple pedagogical illustration of what I'm going to say, that we deal most often with mean reversal models where the, let's say, rate of return is just this P dt plus sigma dw. So the deterministic part is just P to the power 1, and the exponent here is delta equals 0. And you have this simple solution of exponential growth. I'm going to take into account of the positive feedback by, for example, class of models where the rate of return is a function of past price, or maybe even the whole history of the price. And the simplest incarnation is, of course, just to say that the return is just proportional to price to some power delta, which is positive. And if delta is positive, you see immediately that you break the solution, which is this everlasting exponential growth, to a finite time singularity that correspond to the solution stopping to exist beyond a critical time tc. And so in mathematics, as you know, it's called a movable singularity, because the tc, the critical time, is not only a function of the parameter of the equation, but also determined by the initial conditions. Okay, so I'm going to play with this. By the way, this positive feedback and this type of equation here I'm just showing make an extraordinary work to explain the population on this planet in the last several hundred years. So here you see log scale in so 700 million, so 7 billion, 1 billion here. This is linear scale, which is time. And as you know, in a log linear scale, an exponential growth should qualify as a straight line that would correspond to the Malthusian growth of a constant growth rate. What you see is, of course, never a straight line. Of course, you can have a tangent somewhere, but the growth rate of mankind has grown with time. And it's understood by demographs that indeed there's been a positive feedback that the larger the human population, the larger, let's say, the innovation, the research, the exploration of new niches, the medical breakthrough, the agriculture breakthrough, and so on. So, and you see here this inset showing the instantaneous growth rate as a function of population. And it grew, I mean, you see the date, in a very simple way, linearly, which corresponds to putting delta here equals to 1. So having a simple 1 over Tc minus T as a singularity, you would expect if it would continue like this. Of course, when you have an infinity in mathematics, it means evidently that the system is going to disconnect from the mathematical solution after a while when you get too close to the singularity, and other mechanisms are going to dominate. But the main point is that this critical point, this singularity, announces a change of regime, something that is not sustainable. By the way, going beyond finance or beyond demography, this is my non-exhaustive list of the finite time singularities that exist in the mathematical models that describe many phenomena in nature, from the formation in finite time of black holes to planet formation in our solar system, to the physics of plasma turbulence in the tokamak, to front genesis in meteorology. I discovered that recently by expert who told me, yeah, actually it's well known that front genesis, you know, the front that is just passing over us now, is actually described by a finite time singularity in the underlying equation. And so on and so forth, rupture, earthquake, microorganism, and so on and so on, and financial bubbles, I would claim. So, do we see this? So yes, I mean, for example, if you look at the large, famous historical bubbles, this is the tulip price, again, log scale, logarithmic scale, linear scale for the moment, and very simple econometrically. You just have to look with your eye. Do you see a straight line? I see an upward curvature accelerating a return. So explosive, super exponential growth of the price. Same thing for log scale, linear scale. This is the South Sea Company bubble that burst in 1720. And you see again, no straight line, no average behavior fluctuating around an average rate of return, but acceleration. Recently, we have reanalyzed the experimental data on an artificial market. So it's an experiment developed in the group of Karl Homs in the Netherlands. And we were able to actually show that this class of models, so where the return is not a constant on average, expected return is not a constant, but is receiving a positive feedback with the coefficient B2 positive from the previous price, does a very good job at describing the intermittent explosive bubble that they see in this laboratory. And you can see it. So we have a lot of econometric tests on this, but I just want to show you with your eyes, you can just plot the rate of return from period to period as a function of the rate of return of the previous period. And you see that the constant rate of return, expected rate of return, should be constant if it was on the diagonal and, let's say, fluctuating around this point. But then you see intermittent explosion away from the diagonal that a direct experimental evidence for this super exponential growth. Even if all the participants know the fundamental price and so on. And the fundamental price should be 60, and you see intermittent explosion up to the roof, which is limited in the experiment to 1,000, which is not unsimilar, by the way, to the range that we saw from 98 to 99 and at the beginning of 2000, where the NASDAQ sector of the internet went from, let's say, a baseline of 198 to 1,100, a factor of 11 just in 2 years. Very similar behavior. So we have played with and I don't have much time. I just want to show you a kind of potpourri of different attempts to develop mathematical models that capture this idea of positive feedback and finite time singularity to promote the discussion and the feedback. And I will really love this audience who is strong in mathematics to give me ideas or maybe insight to go further. So for example, one model that we have more recently developed, we call it the FTS for finite time singular Garch model. So you recognize the Garch structure for the volatility, and the return is maybe a constant, could be 0. This is a standard volatility with innovation, which is IID. And then this is where the positive feedback comes, similarly to this simple equation that I just showed, where if gamma is non-zero and positive, the larger the price in the previous period, the larger the return in the next period. So you have a super exponential behavior. And so we did a series of tests, simple standard one-sign t-test, and you see for a number of markets, which are known historically to have gone through bubbles, the t statistic really qualified the existence or the relevance of gamma positive. So reject the null gamma equals 0 in favor of gamma positive. More recently, we have extended this to the log, another slight modification of the specification, the log of the price. And there's a lot of tests we have done. For example, we have looked at the rate of false negative, for example, using synthetic tests, and the results are very, very good. The false positive are much difficult because it depends on what is the time series that you take as a null. If it's a simple, let's say, Garch, then the rate of false positives is very, very low. But if there are differential regime, it might be more difficult. But what we find is that when we apply this class of models to, let's say, the NASDAQ composite from 1971 to 2000, we have this heat map that shows, on one hand, the t statistics, and on the other one, the gamma, this parameter, which one non-zero corresponds to the positive feedback component of the FTS Garch. And what we see here, so what is plotted is the value of the t statistics for a network, a matrix of windows where the abscissa shows the T1, the ordinates shows the T2, and we do the analysis in the interval T1 to T2. Because the question is, of course, is where, so moving around, so if you have a time series, you are in real time, when do you see, when can you characterize and diagnose a bubble? And what we see is that ex post, for example, when you look at the full time series, at 2000, we have very, very significant statistics, which are converging to the time 2000, which was indeed the time of the burst of the internet bubble. But we have also ex ante, if you like, or early signals of very significant statistics of the existence of positive gamma. And we have here very significant also large values of gamma, large positive. So similarly, for the Nikkei over the period 1976 to 1992, you remember that it was a big, enormous bubble in the Nikkei and real estate in Japan that was followed afterwards by two lost decades, so to speak. You see a very significant T statistics, so at 0.1% confidence level in red here, already starting quite early in the 70s, and for many ending point of the windows, and with also quite high gamma when around the time when the peak did occur. So it's encouraging that we do see this very robust signature of positive feedback. Let me throw at you a few other attempts that we have developed in terms of writing exactly soluble model of stochastic finite time singularities and what are the tests that we have done. So we start with the standard Black-Scholes formulation where we have a bubble, dB d over b is mu dt plus sigma dw plus a jump process, and we specify the rate of return here and the volatility with an exponent m, which is the same thing as the gamma or the same thing as the delta before, which when larger than 1 correspond to a positive feedback. It turns out that you can solve analytically with a simple Ito calculus this model, and you find that the corresponding price is simply the inverse of a drifting random walk with a certain exponent which is related to this exponent m capturing a positive feedback. So it's interesting because now with the crash hazard rate, with the jump processes, we can from the jump process calculate the crash hazard rate, and if we impose a kind of arbitrage condition, then we have also an equation for the crash hazard rate which is linked by this equation as proportional to the rate of return mu, which can be calculated from the B, and you find that the crash hazard rate actually diverge faster, as can be seen here in these simulations of this process to illustrate what is going on, than the way the bubble would diverge, so that you have intermittent rare blow up when this drifting random walk in the diameter goes to 0, and then you have a crash, and then the process is reset and goes again and again forever. And you have a very interesting statistic. You capture most of the stylus facts. And you can also play the game of you have the maximum likelihood approach here. You can develop the likelihood calculation and calibrate on different assets like the Hang Seng Index until 94, the Asian crisis, or the NASDAQ index until the internet bubble. And you see the data is a thick line, and the light dot correspond to different realization of the model using the parameters calibrated by maximum likelihood. Now, what is interesting also is that this model reduces to the standard Black-Scholes model solution when in the limit m, the exponent goes to 1. So remember that m larger than 1 captures this positive feedback. So we can actually develop a Wilks test of embedded or nested hypothesis and test for the existence of bubbles of this category. And for example, when we do this analysis for the SP500 until the crash of October 1987, we do find, for example, that we reject the standard model and somehow accept the bubble model with m larger than 1. 5 more minutes, 2 more minutes, yeah? But there are other cases, for example, the NASDAQ internet bubble, which is rejected by this model. And we understand that because in this model, the problem is that it assumes that the positive feedback is acting both on the rate of return, on this term, but also on the volatility. And you may remember that at the very beginning, I was shooting for the hip, saying, no, actually, in general, there is no increase of volatility, which has led us to characterize some bubbles as fearful, so that they are accompanying with also an increase of volatility, and others are as fearless. Just to mention briefly, we have recently developed an agent-based model with rational traders, noise traders. The noise traders look at momentum. They also have a degree of social imitation. And you see here some time series of the simulation. The point I want to make here is that this model exhibits very naturally transient finite time singularity or super exponential behavior. This model reproduces all the Stalas facts, so I don't go into detail, but you can actually have a control analytically and show by the couple equation that indeed the price is exponential of an imitation quantity, which is in the regime of interest, is also exploding. So you have also super exponential behavior that you can capture in agent-based model. Let me show you quickly another class of model exhibiting finite time singularity, which is this coupled system of processes, which because now you have two processes. So basically, y is log the price. You have x, which is the rate of return, which is a bit more complicated, with also volatility here. And the rate of return also follows the dynamics, which with the memory of the past, with a positive feedback m. And we have a specification for this gamma and delta, this function gamma and delta, so that we have an exact solution. And this is very interesting because it's generalized this notion of stochastic finite time singularity in closed form. And you can actually estimate this model, of course, calibrate on the data, and you have a specific statistic. So you can actually determine a stochastic time at which the bubble will burst as a function of the observable process, which is the primes from this. What is interesting is that I think it generalized the Abre-Brunnemeyer theory of why bubble can develop because of a lack of synchronization of when the bubble started. Here, actually, in the model, there is a lack of synchronization due to the disagreement between arbitrager on when is the time of the burst of the bubble, which is, I think, much more difficult than saying the beginning of the bubble. So we have developed a methodology from this to diagnose bubbles. And this is what it gives. For example, for the NASDAQ, we have these bars that show when the statistics are passing the threshold, which are not bad in terms of identifying the two peaks before the crisis of 2000 and the crisis of 2007, 2008. The last, so the last minute I have, the last thing I want to show is another type of model, also playing with these finite time singularity models, which is because we often play with both return and price. And as you know, price is non-stationary. And there is a big issue of how do you calibrate models on price. So we develop a model where we specify the structure of the residual together with the positive feedbacks acting on the model. So that we have a possibility of, let's say, calibrating the model directly on the price together with a self-consistent description of the residuals, which here are taken as mean reversal or Einstein-Uhlenbeck, while the process itself is positive feedback with this finite time singularity and so on. So there is also a behavioral discount factor simulation of this. I have no time to explain it, so I could do it privately if you like. But we can actually calculate it and so on, and we can do this horse race with the Bayesian factor and answer the criticism of Cheng and Feigenbaum, showing that indeed this class of models are the winner of the horse race, taking into account again this positive feedback. So to summarize, we have tried, and I tried to show you very quick, a kind of potpourri, as I said, of the key idea, I think, which is very powerful, that positive feedback, super exponential behavior, the rate of return grows itself, probably with a rather complex dynamics coupled with volatility, needs to be tackled and put it in models. It's difficult because we deal now with monsters which blow up in finite time. But as I said, the blow up is announcing a change of regime. And we have played with a series of models where we put in some information on the crash RZ dry dynamic, and then through a kind of no arbitrage condition, it gives specification on the rate of return that the investors require in order to be invested, or a dynamics on the rate of return, as I showed before. So we have a methodology to diagnose bubbles. I don't have time to tell you much more about it, but I can just conclude with telling you the answer, or my answer to this puzzle, or this question I asked at the beginning, which is, why did this home price, this real estate price, stop growing, and then the crisis unfolded through all dimensions from the process that we know? And the reason is very clear. No need for fancy econometric tests. If you just look at the growth rate of the price, the rate of return, so there's no, just by eye, you can see that it started to accelerate, pertaining, therefore, to this class of super exponential behavior with positive feedback, which when you calibrate with any of the model I showed you, then will signify that there is a critical time at which it's become a zone, let's say, where it is absolutely non-sustainable and have to transit. So the answer is very deep, I think. It has to do with the whole dynamic, the whole process, as opposed to a triggering factor that just occurs on the time, on the spot. It's the same thing that if I have an instability of putting this shock on my finger, the proximal reason for instability, of course, is the initial condition, a push of air, whatever, or my shaking of hand. But the fundamental reason is, of course, the fact that it is an unstable regime. And that's what we see here, I think, and that's what these models are trying to capture. Thank you.
There are time for about 10 minutes of questions.
Like a lot I see three types of bubbles.
Can you hear in the back?
Yeah, I can speak louder.
Yes.
I see three types of bubbles. If we consider the traditional definition of a bubble as a gap between some type of fundamental value and some market valuation. What you call fundamental value is very much discussable as part of the. And the three types I see is first a true pure bubble, like the example of the tulip dogs, where the asset. Where people basically buy it only for the reason that they think that someone will be even more foolish to buy it at a higher price, while they know that the asset is not worth that amount. The second type of bubble is when you have a true shift in the economy, in the value of things, and that was, for instance, a question in the internet bubble, where you have a big shift of the economy. Some new assets have a different value. People have no clue where it is. They know it's somewhere else. So this is a part of informed trading. But at some point, there is, you may have exaggeration, and we'll come back and so forth. But you do have, and another example where which we don't know whether it is a bubble or not. But when you see the value of Apple or Google, where the key is pretty important, people are expecting and they're just saying, well, when will it go? And we don't know. The valuation of when you look at the history of the values of the stocks, it has grown like crazy in the past 10 years. And the third type of bubble is also a structural bubble when you have an asset, you know it is not, doesn't have that value, but for some reason that asset becomes like money. And money is a bubble. In some sense, a sheet of paper where declared a certain amount of dollars is not worth the amount of dollars that's given, yet it is accepted. And so it's like an everlasting bubble. And this is exactly what's happening today with T-bonds. Among others, driven by regulation that force people to have those regulations. So the question I have is, in your analysis, very thorough analysis of the various bubbles that you have studied, have you first, do you agree in my separation of three bubbles? Have you separated them, and what are the different conclusions and behavior, knowing that at least two of them do not systematically explode?
So actually, in my opinion, there are more than three types. That's why, okay. It's like, the mechanism of power laws. There's a big literature on this. People believe they were universal mechanism. There are, 20 of them for the same observation of the fat tail, heavy tail structure. Here, I think there are more than three. Actually, I put back this slide to show that you emphasize two, or the third one is a bit separate, but two positive feedback mechanism. And I think, for example, in the case of even the internet, you had this shift in technology, this great hope of innovation, a new economic thinking, but also during the process, when you analyze it, you also see the fuller theory also in action. And what I was trying to show is that depending on the bubbles, you can identify that one may be, let's say, the nucleation factor, then others come and play and reinforce it. So for me, it's a bit more difficult to say there's only one. The list that I showed you here is similar. The excesses that led to the crisis of 2008 have been for some, focused on, this was really the policy of the White House since Carter, blah, blah, blah. So this is a deep cause. But then it was facilitated by all this. And all these are positive feedback. You could say, this is a bubble of deregulation. This is a political bubble of institution, ideology, and intellect. This is, etc. So I think there are more than three. There are many, so that's my first point, is that like power law mechanism, many mechanisms give rise to positive feedback. For me, it's the first thing that I try to teach my student and to, as a new economic thinking, rather than thinking that there is a self-correction and so on, this is the first thing. And recognize that, everywhere you look at, rather than being self-correcting, it tends to be, let's say, destabilizing. So I'm very much in the sense of Minsky in that sense. But what I see is that we have an impression that it is self-correcting because it's a mixture of two time scales, roughly. There's a tendency for destabilizing and then abrupt correction, or there's an asymmetry, either abrupt. So typically you can say that a kind of prototype behavior is a process of deviation from some vulnerable value, and then the correction tends to be faster. For a reason we can, I think, understand. So that's my first answer to your question. I think there are more than 2 or 3 types. Have we tried to analyze them and to diagnose them? A little bit. You saw some example where we had some bubbles where the volatility was an important component, and others they are not. That's one way. And in general, no. I think you open a very interesting domain of research, which is more difficult, of course, because it's so easy to have bubbles in models. It is so easy. As soon as you do one of these ingredients as a positive feedback, then you get this super exponential behavior in this bubble. And then the question is, how can you reverse engineering the dominating mechanism, especially when you have all of them combined and unfolding together and interacting in a multivariate process? So this is a very important question in order to know how to do better policy and regulations like that. But you open a big domain of research. Thank you.
I'd like to thank you for an extremely interesting talk. Many questions. I'd like to ask a couple of information. I was fascinated by the idea of fearless and fearful bubbles. Because as you were speaking, I was thinking of the fearless ones. That's what people usually think of. And as you said that Garrow's theory doesn't hold up, in fact, volatility is actually less in the super exponential growth of the standard bubble, at least in my mind. So my question is, have you actually looked at sort of what's the relative count of fearful and fearless bubbles in the data that you've looked at?
Yeah. Yes. So thank you for the question because it allows me to make more precise this statement. There is a very interesting paper by Batts in Journal of Finance. I think it was published in 1990 or 91, where he looked at the kind of implied volatility index. He looked at the value of calls out of the money 4% on the SP 500 minus the value of puts out of the money 4% divided by the value of call, so it's an index. And this is very nice fear gauge, if you like, because when this index is high, it means the calls are much more pricey than the puts, so the market is betting on the upward. When it's negative, the market is betting or is fearful, let's say. And what you see and so we analyze the trajectory of the 1980s before the crash of October 1987. And what he found is that this index goes through big waves of positive, so the market is very optimistic, and then crashes, and then in a kind of oscillation, positive, negative, in an accelerated way until the crash. So it's not completely true that there is no fear or no volatility increase, but it's intermittent and follows a certain dynamic. What is certainly true is that in the months preceding the crash of October 1987, this index was very positive. So the crash did occur at a time when the fear was not there. But during the bubble, it did occur. And actually, when you not only study the dynamics, but also you ask to participants, to professionals, and I've had this opportunity a lot, they tell you that they knew, many savvy, smart money, hedge fund, they knew that something was, and all bubbles, they actually often sell at the right time, the smart money, so to speak. So they knew, and this, I could interpret this gauge that goes negative at the put price becoming, explosive, at the fact that the guys say, okay, now is when it's going to explode. But it does not. And then it's a calm, solidification, and then it's recovered again to the next wave. And this is one of the things that we are trying to actually calibrate with our models, this combination of the price dynamics and the volatility. Now, in the 50K, the working paper that we have with 50 bubbles worldwide, it's a minority. Less than 10 are fearful. Yeah. But there are some.
One more question. You took a man off the street in Toronto, walked him in, and showed him, I think it was your first slide.
My first slide.
You said...
This one? This one?
What will you have me... Yeah, said we have real difficulties deciding or detecting bubbles. And then the little man in the street says, well, wait a minute, the stock markets are going up like this. And now if I sell those assets that I have there, I have now a claim on all the other assets at current prices. How is it possible that the stock markets actually rise so much more?
Oh, this one.
Assets, or fall much more. Therefore, there must be something wrong, quote, a bubble, if you like, in the system. I mean, most people would feel that if the valuation of Volkswagen stock goes above the GDP of Nigeria, that there's something incoherent in this. So at this point, I think that's one measure of a bubble, is where you have expansion of financial assets, the prices far away above the expansion of all other prices. The second observation is, shouldn't we be saying, given the people responsible for this, reflexivity instead of positive feedback? Because
no, so I can answer to the brief, if you allow me, a brief comment on both. I love your comment, Alan. The first one allows me to make the following point. In hindsight, what you said is super clear, obvious to everyone. It's even, I remember this conference in Frankfurt, when was it, 2010, organized by the ECB and the Fed, with one of the economists of the Fed concluded, yeah, you had a great moderation. We had all these indicators, solid, predictable GDP, low unemployment, predictable and low inflation, and so on. Never happens. Clearly, there was something wrong. I mean, there's something abnormal. I stand up, I shout in the room, and I said, come on, everybody, all economists, except you, Alan, and maybe me, we're saying this is a new economy. We are the master of the world. So you know the story as I do, yeah. So your remark is good, except the new economy thinking. And you know, when as a student of bubbles, in the Wall Street Journal front page, 1929, new economy. Never again recession, forever growth with a new way of accounting value. 1962, the front page of the Wall Street Journal, new economy, the tronic boom. 2000, the Wall Street Journal, new economy, forever internet is going to change. They're right. They do change the industry. They do change. But they forget that any innovation takes between 10 to 20 years to give real value. As the PC, the personal computer paradox showed, it took 20 years for the economy to find the productivity gain of computers. And this is one of the things that you are studying with Zenaway and you too and so on, which is indeed the extraordinary cause of role of innovation, but it takes time actually to be in the real economy. So I think your remark is interesting, but even the men in the street would be so happy because they are so rich that they will not question this. And they will question anyone like me or like you who would say, no, this is absolutely like, I call it a perpetual money machine. You're extracting money of a virtual sphere, which is unsustainable, is going to crash. And we will be called, Dr. Doom or whatever, yeah. So I think you are, in hindsight, your statement is correct, but I think these statements tend to forget the psychology of the time. And this is my main criticism of the study that I see that find obvious the abnormalities that were developing until 2008, because it's obvious after the fact, but nobody saw it during. And if we don't integrate this endogenously in the system, in the models, then we will not be able to make a... Yeah. The Ford effect, yeah. Yeah, exactly. Yeah. But let me just briefly comment on the reflexivity. We are working actually a lot on reflexivity. We have maybe a future grant on reflexivity. Reflexivity, we can capture it actually with models that do not give rise to this super exponential behavior. So there's a distinction for me. So for me, reflexivity is the fact that there is a kind of triggering, a kind of process of triggering of the future activity endogenously on the past rather than news. Normally, as you know, stock market should be an engine to transform news, information into better value to assess the value of the future. But if the price moves a lot, excess volatility and even bubbles, without input of new information, but endogenously or reflexivity from the past activity, then this is a process which is very important to capture. It may proceed without this process that I'm referring to, which is this super exponential behavior, positive feedback of price and return. So for me, that's why I distinguish the two, because reflexivity is a bit broader, while positive feedback is a kind of subclass of this for me, just as a kind of clarification.
You put up the famous supply-demand cross and then compare that, because if you have the slopes of those things right and you have the cobweb adjustment, even that would be explosive, as you know.
Yes.
Even the thing on the left.
Yes.
You reverting.
Well,
We stop, yeah.
Stop there.